Welcome to Discovery Watch with John Kaiser.
I'm your host, Jim Goddard. Welcome back to the show, John.
Jim, it's a pleasure to be on the show.
John, last week, Cleantech Sam Riggle wrote a 5-page open letter to the world's leading automakers. What was that all about?
Well, Sam Riggle is the CEO of Robert Friedland's Cleantech Holdings, which completed a definitive feasibility study in 2018 on the Sunrise Nickel Cobalt project in New South Wales. And we've talked about this project a number of times. Sunrise originally started as a low-grade nickel cobalt project called Sierston, which mutated into the world's richest Scandium deposit, and then was reborn as the Sunrise project, a much larger scale nickel cobalt operation that was going to produce sulfates for the electric vehicle battery sector, and Scandium as a byproduct that they were going to stockpile until a market for this material actually develops. Now, the project is supposed to cost about $1.5 billion, operate at 7,000 tons per day, it's an open pit operation, and produce about 89,000 tons of nickel sulfate and 21,000 tons of copper sulfate annually. Now, nickel sulfate is generally made from refined nickel, which comes from nickel sulfide mines. It has to be smelted. So nickel sulfate has an extra processing cost. So they used gave themselves $1 per pound premium for producing nickel sulfate directly from their operation rather than having to go through smelting as the nickel sulfide producers do. But the DFS implied a net present value of $1.4 billion and an internal rate of return of 19.1%, which barely meets the development hurdles of for a 25-year mine, where you want the capex to meet the NPV, and where you might want to see something better than 19% as an IRR for an operation of this scale. The problem, however, is that the DFS assumed a $7 a pound LME nickel price and $30 a pound for cobalt. And that was in 2018. Since then, price of cobalt has fallen more than 50%, partly because the Congo ramped up production from Glencore's and the various Chinese operations with the cobalt byproduct supply from their big copper mines there. But another was that the battery industry is really freaked out about relying on cobalt, which comes 65% from the Congo, which is one of the more unstable parts of Africa and also a quite corrupt place. So a lot of effort has gone into both substitution and thrifting. And the most effective has been thrifting, which involves reducing the amount of a critical material that you need to achieve the same functionality. So the lot of copper that went into the lithium-ion battery cathode is a lot less today. They've managed to introduce nickel, aluminum, and manganese as a way to reduce what cobalt does. The holy grail for the battery market is to get away from copper entirely, and even better, get away from lithium, because lithium has this runaway heat problem, and an important role that cobalt plays in the cathode is to prevent this runaway heat problem and also to increase the life cycle of the battery, because you don't want to be changing all those Tesla batteries every few years. You want it to last at minimum 5 to 10 years. And Tesla's Elon Musk has been on record as saying he'd like to produce a cobalt-free Tesla. But at this stage, the alternatives, they're still probably, a decade away from commercialization. Things like a magnesium-ion battery, which doesn't use lithium or cobalt. Such things are on the drawing board, but they're far down the road, and the electric vehicle industry is pretty much going to use the lithium-ion battery as it continues to expand the production of electric vehicles. But with the collapse in the price of cobalt, the Sunrise project is nowhere near being viable for development. And there's also this issue with the cobalt that although most of it comes from formal mines in the Congo, some of it comes from the Kivu region in the northeastern part, and that's a conflict area where the cobalt is mined from very small scale operations, and that cobalt ends up being mixed into the supply that gets fed back out of China, and which the various battery makers buy. So there's this background problem of you may have a nice clean energy electric vehicle, but is it tainted with the equivalent of a blood diamond because it has cobalt whose origin you cannot verify as not coming from one of these conflict regions? Now, all of this caused the price of clean tech to collapse 90% from a high of $1.80 a couple of years to its current level of 20 cents, where it's basically just sort of floating along, waiting for something to happen, such as the cobalt price to go back to $30 and nickel to get back to sort of $8 a pound. Now, Sam Riggle's open letter attacks the myopia of the automotive sector for failing to really think about where is their metal coming from. And there's this textbook philosophy of you call up your metal trader, you order the stuff just in time, and you make your stuff, you save money, you don't stockpile this in a warehouse, you just order it from the market. And this whole idea, which is based on globalized trade, where the lowest cost jurisdiction makes the stuff cheapest and delivers it to whoever it has, this whole concept is now under attack. Earlier this week, Robert Lighthizer had a New York Times opinion piece where he's in essence declaring the age of globalization over. The deglobalization process is in effect. Everybody is now thinking about their supply chains. They're trying to localize them, get them closer to home, and not rely on supply chains whose key parts are concentrated in certain parts of the world. And this is all part of this, pushback against China and the American agenda to bring manufacturing back home to the United States. But what Sam's letter also addresses is not just the vulnerability to having everything come from certain parts of the world on a just-in-time basis, but he also points out that the auto industry is not really thinking through the consequences of their eventual success in building out their electric vehicle fleets. For example, he says that the lithium demand in 2030 will be 10 times current world supply, whereas cobalt demand would be, even with all the thrifting that's happened, would still be 6 times current supply. And his open letter accuses these companies of not really thinking about where their future supply is going to come from as they succeed in rolling out technologies that represent an entirely new type of demand and a new source of stress in the market. And the problem is the mining industry, it operates by profitability. And so here he has Cleantech's got this Sunrise deposit. It doesn't work at $5.50 nickel or $15 cobalt. And yet 10 years from now, there will be far more demand for these metals than there is available in the current supply infrastructure. But any mining company who says we're going to spend $1.5 billion to build a mine that is not going to make money at current prices, they would be crucified. So there's this disconnect between what these automakers need and what the mining industry is able to deliver. And what Sam Riggle's really calling for is for the automotive sector to wander upstream and become investors in ensuring that they will have their supply down the road. And this flies completely in the face of the just-in-time philosophy in a globalized context where, the cheapest producer will be the biggest supplier, and everybody's happy. Trade goes swimmingly great. But all of that is now coming under siege with the ramping up of the blame China for the virus as a way to distract from the from the economic downturn that the response has created. And so Sam's letter is quite timely. Back when the rare earth bubble started in 2010, 2012, we talked about, you end users who rely on these rare earths, you need to invest in these rare earth companies because you're going to be in the future jerked around by China again. Back then, China let this whole thing get out of control as a geopolitical spat with Japan over the Senkaku Islands, and they let the prices run way up, and it ended up backfiring on them because the end users ended up substituting and thrifting. And when China finally eased the supply restrictions and let everything go back to normal, prices ended up even lower than they started before the bubble because there had been so much demand destruction down the road. But over time, the total demand for these rare earths has continued to go up, and the concentration of rare earths in China continues to be as it was before. And the problem is still there. If for whatever reason China becomes unable or unwilling to supply the rest of the world with rare earths, what is the rest of the world going to do? So, Sam's letter is, I think, an important message to the industry that you have to think differently. And by industry, I mean the end users, and with the imperative now to create more redundancy and localization of supply chains so that they are resilient to these sort of supply shocks. The time is right for a different type of attitude to be taken to these exploration projects. And this is, of course, good for the junior sector with the pounds in the ground type deposits. This does not apply to gold because nobody actually needs gold for any consumer product. Gold is just an end in itself, and if you need some, you simply pay whatever the prevailing price is. But for almost every other material that is used in the consumer world and industrial world, this problem now needs to be dealt with. And if anybody thinks that dumping Trump is going to change any of this, they need to wake up, because the anti-globalization backlash is now supported by both ends of the political spectrum. Even if the Democrats end up in charge in the United States, this push for reshoring supply chains is not going to go away. And for new technologies where they are actually going to create substantially higher new demand, they need to also think about making strategic investments, even though they don't make sense today based on the current market's metal price. And especially in today's COVID-19 environment, where we have had incredible demand destruction, which has created weak prices for everything. COVID is a temporary problem. It'll take a couple years to resolve, and things will bounce back after then. But you can't use the low prices of today to guide all your long-term decisions with regard to securing the supply of the raw materials you need for your business.
We'll have more with John Kaiser right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with John Kaiser. John, FPX Nickel has a deposit with a much lower nickel grade than Cleantech's Sunrise project. How is it dealing with the market pessimism about base metals?
FPX Nickel does not have the problem of Cleantech's Sunrise project, where it needs two metals to go up significantly, in particular cobalt. The Decker project in British Columbia it's a pure nickel play, and it's very low grade, 0.12%, which is there is no deposit in the world that is in production at that grade. But it is a different style of mineralization, a natural stainless steel, and it appears to be a unique system of, couple billion tons, of which 1 billion have been selected for mining, 120,000 tons a year with a 40-year mine life. And the work in 2014, Cliffs did a PEA on this project because it saw this as a supply of material for the stainless steel industry, not as a refined product, but as a concentrate that could be fed directly into steel mills, similar to what the nickel pig iron phenomenon is in China, where raw laterite ore is shipped from the Philippines and Indonesia to China and put into their blast furnaces to create a form called nickel pig iron that then can be fed into the stainless steel mills to make the whatever quality of stainless steel that they are happy with over there. But the Cliffs PEA suggested $9 a pound, and since then we haven't seen $9 a pound in the past 6-7 years. And so the Cliffs abandoned it. FPX Nickel got it back, but it's been doing work to change the fundamentals of it. They drilled off the higher grade portion of the Baptiste deposit and then optimized the ore schedule so that you have higher grade ore at the beginning of the year, whereas Cliffs just used the average life of mine grade throughout its cash flow model. They also did some R&D on their flow sheet. They added a flotation circuit and were able to boost the concentrate about 4 or 5 times into the 50 to 65% range, which reduces your shipping costs and makes it more attractive for feeding into these, stainless steel mills. But most importantly, and this they finally got confirmation last year, they were able to demonstrate that from this concentrate they can make nickel sulfate, which is the product that the battery makers need, and which is what Cleantech hopes to produce directly. So in a sense, there is a similarity between FPX Nickel's Dakar project and Cleantech's Sunrise deposit, except that the FPX project does not involve cobalt. Now, they've been sitting on these numbers for a while, and they made a decision earlier this year to proceed with an updated PEA. It's now expected either late in the third quarter or early in the fourth quarter. All the stay-at-home rulings do not affect getting this completed. It's basically a formal number crunching exercise, and they were able in late February, before everything got really grim with the COVID-19, to complete a $1.5 million financing at 18 cents with no warrant. And it was a very unusual financing because 73% was taken down by insiders. And yeah, they have been backing this project for quite some time. But quite surprisingly, 13% was taken down by pros, which are brokers. And that's almost unheard of, that a broker would take down a financing without a warrant. That's very unusual. So that shows that there's considerable sort of smart money support for this project. So they're dealing with it by proceeding with the PEA, which will tell us what the cost structure is. Nickel's now around $5.50. They haven't really hinted what price they need for this to be worth developing, but they also are thinking along the lines of what Sam Riegel is thinking, that this project will end up being of interest to somebody with a long-term need for nickel, possibly even with a nickel sulfate need. And the eventual buyer of this may not be a traditional mining company, but another entity which is securing its long-term future. So in a sense, Martin Turenne and FPX Nickel are also coping with this new reality where the question, where does your metal supply come from, not just today, but in the future, becomes a major factor in thinking about whether or not to invest in developing this project. And that's an opportunity for us resource sector speculators to be able to look at these projects, which may not look so great at the metal prices that we have today, but in this context of a world fragmenting into a deglobalized trading system with metals preferentially coming from different parts of the world that may not be the ones that are friendly to yours. It's a new way of thinking about the non-precious metal sector amongst the resource juniors.
We'll have more with John Kaiser right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with John Kaiser. John, Scandium International announced a new plan to recover scandium and other metals from existing copper mines in the U.S. What's that all about? And what does it mean for the proposed Nyngan mine in Australia?
That would turn this into a $10 to $20 million business well before they start producing from the primary scalable Nyngan mine. And so that idea was floated in the middle of last year, and everybody thought, oh, that sounds like a great idea. That's kind of a transition, a gradualist way of developing the offtake market and being this business rather than just some poor little miner has to raise capex and then sit for 2 years waiting for production to start. But the problem was, where do you get the scandium from? Well, there is only one source. That's China. And they get it from a bit of it from the Bio Noble rare earth mine, and the rest of it from these titanium dioxide waste stripping operations. And they're selling it right now, below even $1,000 a kilo. But there is no reliable size or even any reliability in getting this. So it wasn't really an option for SCY to pursue a Chinese source. So great idea, but not executable. And that's where we were at the start of this year. The shareholders were pissed off. The stock was down at 6 cents. The company wasn't coming out and telling us that, our whole LOI strategy is a bust. It was clear that they were out of money. So it looked like the end of the story. But while all this was going on, Willem had gone back to his SXEW route. When he emigrated from Holland to the United States in 1972, he was able to do this, get a green card on the basis of his experience with SXEW, which was still in the early stages at the time. Now, SXEW processing of copper oxide ores, you crush the ore, you put it into a heap, you dump a bunch of acid on it, which leaches through the pile, and you collect it, and then you use solvent extraction to pull out, precipitate the copper out of it, and then that goes on to the electrowinning stage where copper bars are made out of it, or copper plate, and you bypass the smelters, which the sulfite producers who use flotation to make a concentrate. They have to ship their copper to a giant smelter. So this has become the whole new method of dealing with copper oxide projects. And Willem's experience, he built on it, and he managed to convince 3 copper mines in the United States to lend him or give him some raffinate. And the raffinate is, after they've done the solvent extraction, pulled out the copper, it gets pumped back, dropped into the pile, more acid added, and it just goes on in a circle. And eventually, when the copper is largely gone, they just shut it down. The fluids eventually evaporate from the pile. And what other metals are dissolved in it, they end up just precipitating back into the pile. And the mining companies know what's in the solution because they do all the chemistry, chemical tests of it. And they've often wondered, can we recover this? But they've never really had a method for doing this. And in terms of value, it pales against the value of the copper that they're producing. Now, in the United States, there are 18 copper mines, primary copper mines, and 13 of them are these oxide SXEW operations, and the other 5 are sulfide operations. And 1 million of these, of the 1.5 million tons that are produced in the United States, or 1.8 million tons, 1 million of those tons are done by 5 or 6 operations by Freeport. So when Willem collected these raffinate samples, and I suspect it probably was from Freeport, he was able to establish what other metals were present, and scandium was one of the ones that dissolves into this raffinate, and scandium is like 22 parts per billion, which parts per million is what its crustal abundance is, so there's some low percentage of it in there, along with other goodies. And he played with ion exchange technology, with which he also has experience, and then obviously it works in China, getting the scandium out of the titanium dioxide waste streams. And that titanium dioxide is made, turned into pigment for the paint industry. And he filed a patent last year for recovering scandium and other metals from the copper raffinate produced by these copper oxide mines. And that patent isn't granted yet, but they believe that they have protection for applying this method. And so they came out and said, this is what we're going to do as our transitional strategy, since we can't really crack the chicken and egg problem in terms of getting the primary mine going. We're going to approach these copper producers and do a deal where we'll recover the scandium and anything else that we can, and we'll do some sort of revenue splitting deal, and we'll be the buyer of the scandium, which will be able to feed into our melt shop, and we'll be able to start supplying various parties with this who need it on a small scale basis, and also continue to develop our offtake model so that maybe in several years, when we've got this going, we have enough of an offtake order book built that we can raise the $100 million and put Ningen into production as a 40-ton per annum powerhouse that can be expanded to over 100 tons per year, and eventually turn Scandium International into the scandium powerhouse that controls much of a market that could eventually be 1,000 tons per day. And the timing of this is good because the market is sick and tired of hearing about scandium, but the critical metals theme is the other mania that's going to evolve alongside the gold mania that's coming as a result of the deglobalization, the response to the COVID-19. And it dovetails very well with the Defense Department's interest in securing domestic source for some of these more obscure metals. And they haven't told us what they hope to recover other than cobalt and hinted at rare earths. What they can recover is not going to solve the total problem. But if we go into a period where they become serious about reshoring supply chains and hostilities with China escalate and material that normally comes from China stops coming from China, there will be at least a transitional supply from domestic copper mines, basically a wasted resource right now from the copper mine as well. It's not going to be a big deal in terms of their bottom line relative to their copper cash flow. But on the other hand, if the Defense Department is in there saying, this would be really helpful to do, it's quite conceivable that the producers will say, well, gee, if we're doing this for the wellness of the strategic security of the United States, I'm sure you'll figure out some way to help us permitting something else that we need to get going that's also a domestic new mine. So in my view, this is an elegant solution to what looked like a hopeless problem, and it marries the Scandium story to that of the critical metals trend that's going to come, and it makes it attractive to an American investor audience because they've all been through the rare earth bubble and they've seen what it can do. And the Scandium one's hard to swallow because the world's done without Scandium forever, and consequently can do so indefinitely. So nobody's really into that. But if it's tied in with securing a critical metal supply from a resource that's otherwise wasted, and then it facilitates putting the primary scalable mines production, well, that becomes a much more interesting proposal than trying to coax various end users to commit to something that they won't receive for a couple of years from when they commit to it.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.